Welcome to our Storr University seminar, How to Get Insanely Rich, Chapter 3. I'm Chris Volk, CEO of Storr Capital, and I initially created a 10-lesson course series entitled Storr University to help business leaders understand the essentials of business value creation. In this new seminar series, we'll help you understand how to materially impact your own personal wealth creation, or in other words, how to get insanely rich. In our first two chapters, I discussed the 4 ways to build wealth. The 4th way to wealth is to invest in a good business, which is what this seminar is about. This is how most of the Forbes 400 list of richest Americans got there, and this route offers the highest probability of creating insane amounts of wealth. And the secret to business wealth creation is to deliver investor returns that exceed expectations. But to understand this, we have to first understand the 6 components that comprise investor returns. So in our last chapter, we discussed the first 3, which are sales, investment, and operating profit margin, and now we're into the final 3. So the next 2 variables are related, and they're very simple. The first of these is the cost of other people's money, or OPM. OPM, you might remember from Chapter 2, is money from other people who are looking for contracted payments. So this could include bank debt, equipment leases, real estate leases, non-bank debt to family members or others, or maybe even preferred stock. Take the interest payment obligations that you have to make and divide this into the amount of money advanced by all of these other people, and you have an effective interest rate or current OPM money cost. If you're leasing real estate or equipment, the interest payment obligation may not be included, in which case you'll just have to divide the payment that you're making over the next year or 2 into the proceeds advanced. Now, you may be leasing space in a multi-tenant building, in which case it's impossible to tell how much the landlord has to advance for you to lease this space. The answer here will be to modify the equation slightly to add the lease payments to your operating expenses, which will lower your operating profit margin percentage, just a smidge. And if you were to include all of these lease payments in your operating expenses rather than think of them as separate charges for OPM, you would effectively be changing the definition of operating income from EBITDAR, which is earnings before interest, taxes, depreciation, amortization, and rents, to just EBITDA, which is another commonly thought of definition of company operating profit. So now that you have the cost of OPM, your next related variable is the proportion of OPM used to finance your business. Businesses are funded with OPM and investor capital, which is often simply just called equity. Included in investor capital will be your own money, which I'll call YAM. So, if you own all of a business and put up all the money yourself to make that happen, then you have simply a mix of YAM and OPM. However, if you relied on other investors to help finance the formation or growth of a company, then your mix was going to change to OPM, YAM, and other investor equity. From your vantage point, other investor equity is similar to OPM, it's just a different form, but we'll get to that later. Anyway, what you're solving for is the mix between OPM and equity. In the case of our example, we'll assume that you have to come up with $250,000 out of the $1 million investment needed to form this business. Therefore, the mix of OPM is 75%, and the equity mix is 25%. That's the 5th variable. By the way, OPM is often referred to as leverage. Leverage can be expressed as a percent, as in our company is 75% levered, or often leverage is referenced as a relationship of OPM to EBITDAR or EBITDA, which is usually expressed as a multiple, as in our borrowings of $750,000 is 2.5 times our EBITDAR of $300,000. Since the use of OPM involves locking yourself into payment obligations, which raises the amount of your fixed cost, leverage increases business risk. So as a rule, lower levels of fixed cost resulting from the use of OPM relating to your operating profit margin are best. By the way, the ratio of OPM to EBITDAR of 2.5 times, as in our case, would generally be considered strong. And the pre-tax cash flows of $300,000 a year cover the interest and rent expense of $67,500 by a factor of more than 4.4 times, which is also considered a highly favorable ratio. Okay, so now we get to the 6th and final variable, which is needed to calculate investor returns, and that's the amount of new investment that you have to make every year to keep your business going. To keep it simple, we will assume that sales stay flat, which would mean that the investments you have to make in inventory and accounts receivable and prepaid expenses also remain flat. There is therefore no need to make any more of these types of investment, which tend to stay fixed relative to sales. However, were you to assume material sales growth from your business, you'll have to consider how much added investment in these items, which people call working capital, you're going to have to make. And by the way, working capital investments caused by sales increases could simply be inflationary, which is a big reason why inflation can be so ugly from a business vantage point. So, back to capital expenditures. Equipment wears out and needs to be replaced every year. And you may even need to make material investments every 5th year or so just to keep up your place of business. Think about a restaurant that undergoes a major facelift every so often. Such work is generally done not to increase revenues, but defensively to keep the revenues you already have. Anyway, take your average annual capital expense needed to maintain your business. In our example, the amount is $20,000 a year. Divide that amount into your original $1 million investment, and you get a capital expense annual investment requirement of 2% of your original investment. That 2% is the 6th and final variable to compute investor rates of return. So, the variable is a percentage of average annual investments that have to be made as a percent of your original investment. And unlike accounting depreciation or amortization, which is an estimate, this amount is more accurately determined and budgeted. It reflects your expectation of your true annual investment outlays to keep the business operating. So now we have our 6 variables to compute investment returns. These are the important building blocks of creating insane wealth. And what about the return on investment in our illustration? It's 85% a year, which you get by dividing your cash flow after paying for OPM and annual added investment of $212,500 into your initial $250,000 investment. By the way, that's technically a current pre-tax rate of return. Why do I call it current? Because the 6 variables we have might change next year, and they often do. Why don't I focus on after-tax rates of return? Well, because companies in the United States mostly don't pay taxes. Earnings are taxed at the shareholder level. But were we a company that did pay taxes, we would assume a marginal effective tax rate. In our illustration, let's use 25%, which lowers your cash flow to $159,375. And so also lowers your current annual return to 63.8%. Now, there are 2 final points before concluding our discussion regarding how to compute equity rates of return. The first is that your current pre-tax annual profit of $212,500 should be computed after your own salary is taken into account. That is, if you or other shareholders have a job working for the company in which you have an ownership stake, then you have elected to hire yourselves to run it rather than others. In fact, you could have taken just another job doing just that for someone else. To exclude managerial salaries would be to artificially lower a company's operating costs and artificially inflate investor returns. In our case, the 85% current pre-tax rate of return must be solely what's achievable by the investors as compensation for taking the risk to make their $250,000 investment. And the last point is this, and it's actually more of a question. Do you think that an 85% annual pre-tax rate of return is unrealistically high? After all, Warren Buffett's compound annual return since 1965, as seen in our first chapter, was 20%. And the historic long-run rate of return for the S&P 500 since 1928 averages around 10% annually. And the answer is actually that 85% is not at all out of the ordinary. And certainly every self-made individual on the Forbes 400 list of richest Americans has realized rates of returns far in excess of the broader stock market. With that said, you now know how to compute a current investment rate of return. Such knowledge should be common, but I can assure you that it's not. And now you have an advantage. We're often taught to compute investor rates of return by looking at net income numbers prepared by accountants and then comparing them to equity numbers prepared by accountants. But net income is not cash flow, and equity numbers on a financial statement balance sheets do not generally come close to the actual investor capital deployed. What is more startling is that trying to compute original investment amounts from an accountant-prepared financial statement is often nearly impossible. So this seminar is not offering you a lesson in generally accepted accounting principles to determine investor rates of return. We're instead simply sticking to some very basic rules of finance. Accounting is designed to offer a reflection of finance, but there are distortions in that reflection. And with that, I'm Chris Volk, thanking you once again for joining me on this value creation journey.